All right. Good morning, everybody. It is Saturday morning, 1 minute to 9 o'clock, and this is going to be our VITA training session number 4. Our instructor, field agent, no, retired agent, Jerry Muir from the IRS, now working at Coast Community College, teaching tax law and VITA volunteers. I'm Sean Gahn. I'm the training coordinator for the St. Killian VITA site. We have Mel Alfonte online. He's our site coordinator this year. You want to say anything, Mel?
Yeah, hey, good morning, everyone. Thank you for continually attending this very helpful session that St. Killian sponsored. And for all volunteers or prospective volunteers of St. Killian, we will have a breakout session maybe after the holidays. Stay tuned from Sean's email. And then we will be discussing further the site operation and then our challenges while we are taking our certification, your challenges, and how we can resolve it together. And again, good morning to everyone, and back to you, Sean.
All right. And then before I turn it over to Jerry, I just ask for God's blessing on all of us today, that our minds are open to this knowledge and we increase in knowledge and wisdom so that we're able to help our neighbors who need assistance with their taxes. And we ask this in God's name. Amen. All right, Jerry, I'm turning it over to you.
Okay, thank you. Good morning, everyone. Jerry Muir, and hopefully you've had an opportunity to join us for all of the other sessions that we've had. This is session number 4. 2 things before we get started. Number 1, on the scenario, the John and Lisa Morgan tax scenario, if you can make a pen and ink change. John, the taxpayer, he's completely blind in his left eye, and in his right eye, his best vision corrected is 400 over 800. And so what that means is John meets the tax definition of blindness, and so that is going to allow him that additional standard deduction. And then another item for next week, that'll be our last session. We are going to do the deep dive when it comes to the Affordable Care Act and covered California. So we'll have at least one scenario. I'm thinking of having perhaps a second scenario where we go through and the taxpayers are in covered California, so we can address that premium tax credit, and might even have a scenario for the excess tax credit. So again, those are the 2 things that you should be aware of. So let's go ahead and get started. And let's see here. Give me just a moment. My brand new computer screen has frozen. Okay, and here we go. Okay, a little bit of history for those of you who like history. This photograph was provided by Sean. This is the headquarters of the IRS in Washington, D.C. And there's a saying that's chiseled on the, I guess it's concrete or granite. Taxes are what we pay for a civilized society. That comes from a federal judge who was deciding a court case, basically telling the folks in the case that, yeah, you're paying your tax, and the reason you pay your tax is because the government, purportedly, the government will use those taxes in a good way for our society, for the common good, if you will. If you haven't been there before, it's an imposing building, like a lot of buildings in Washington, D.C. And in that building, you've got the headquarters folks, i.e. the commissioner and the commissioner's staff. And then you also have just regular offices for that particular area in the country. Okay, so this morning we're going to go through a couple of things. We're going to talk about other taxes. And as I tell people, there are federal income taxes or individual income taxes, and then there are other types of taxes that we pay sometimes on our Form 1040. We'll revisit the earned income tax credit, talk a little bit more about that. We'll talk about refunds and amount owed. We'll discuss quality review, and this is important. I've been a quality reviewer. I've had my returns quality reviewed, and sometimes it's great, and sometimes you're told that you didn't do the right thing, and that's going to happen. As I've mentioned, I've never met anybody in my life who's a tax preparer, both professionally or an amateur or a volunteer, who hasn't made a boo-boo or a mistake on the return. But the whole goal with the VITA program is to have that quality review to catch most of the mistakes. And then we'll talk about concluding the interview, finishing the return. Some other topics, we had some questions from, I believe it was a couple of weeks ago, so I'm going to do my best to address those. And then again, we're going to jump into that scenario that John and Lisa Morgan. So once again, if you have that scenario or you worked on it, do make a change. John, the taxpayer, he meets the definition, the tax definition of blindness. Okay, so we're going to go from 9 to noon. We'll take breaks at approximately 9:50 and 10:50. And we've already introduced you to the St. Killian's VITA team. You've got your site coordinator, your assistant site coordinator, you've got your training coordinator, and all the other folks that help out. If you're new, or if you're fairly new to the St. Killian's VITA program, I can tell you from my personal experience over the last few years, it's a really good team. They're experienced, they're passionate, they're compassionate, and I think they do a really good job. And they've got good numbers as far as site return production. And then as far as competence, I've met a lot of people there at St. Killian's. They're good preparers, they're good quality reviewers. So you got a good team. And if you're new or fairly new, you're in good hands with St. Killian's. And then that's me. That's how I spell my name. Okay, you've seen this before. If you haven't, that means you haven't jumped into the practice lab. And so what that means is the practice lab is the TaxSlayer Pro tax preparation software. That's what it uses. And I think it's a user-friendly tax preparation software. And like anything in the world, it's not perfect, but it is pretty good. And then you should keep in mind with the practice lab, especially for 2021 tax year, it is a work in progress. And what that means is the software folks continue to work with it, to update it, and to perfect the practice lab. Now, when you're working with the real software, i.e. for live taxpayers in late January, early February of next year, you're going to be using the TaxSlayer Pro, and most of the bugs, if not all of the bugs, will be worked out. And I think I mentioned this before. I've used TaxSlayer in my practice. I've used TaxSlayer as a VITA site coordinator. And sometimes what will happen, you'll bump into something where you scratch your head and say, this doesn't make sense. And then, of course, you push it up to the IRS, and then TaxSlayer says, oops, we didn't do something, and then they fix it. And that's happened a number of times. But again, that's just the way it is. We use this particular software because it's provided free to us. And again, it is pretty good. I think last season I found one mistake where I had to call TaxSlayer, notify the IRS, and then they ended up fixing whatever it was for a couple days later. I checked last night, the California software was not available. And so if it came online this morning, I'm not aware of that. But right now for tax year 2021, you only have the federal software available to you. And I'm not sure when the state's going to be hung there, but I would imagine probably in the next week or two. And then I also mentioned this, and if you're fairly new or if you're new, the tutorials in TaxSlayer or the Practice Lab, they actually have a number of pretty decent tutorials. They go anywhere from like about 2 to 3 minutes to maybe about 9 to 11 minutes. And what it is, it's kind of a refresher training. So here's my recommendation. After we complete our training next week, over the holidays, like anything, people are going to start forgetting things. Maybe at the beginning of the new year, opening up the practice lab and going through some of those tutorials to get a refresher wouldn't hurt. And then again, in TaxSlayer or the practice lab, you've got practice returns and solutions. I would recommend you do not tackle the one that's married filing separate. In the VITA program in California, to my knowledge, we do not do married filing separate returns. So you can ignore that and just work on the other scenarios. Okay, any questions about the practice lab that's out there? I'll hesitate for a moment, and if someone has one, or if they want to throw something in the chat. And Sean, can you monitor the chat?
Yes, Jerry, I'm monitoring it. There was one question came up. Somebody just wanted me to remind everyone that the IRS sent out a correction on the 6744 re-exam booklet. And I already sent out an email to all the volunteers, but just be aware if you're using the paper booklet that there were some printing errors. The IRS has sent out a correction, which was forwarded by email. And if you don't have a copy of that, you can contact me or Omid at the United Way, and we'll get you that correction sheet.
All right, thank you, Sean. And that's a good point. And I'll tell you how I do it. You're going to do whatever you want to do. When I take the certification, I will sit down with a couple of computers. I will have a hard copy of the form 6744. That's an IRS form, which is the VITA test retest. And then what I'll do is I'll go ahead and answer all of the questions based on what I have in my brain, what I'm looking at on the form, the publication 4012. And then once I complete all of my answers in the form 6744, then I go online, go to the certifications, populate the test, hit submit, and thankfully pass. But that's the way I do it. I find that to be very helpful for me, because what I'll do, I will jot down in the form 6744 where I found the answer, whether it be the publication 4012, the publication 17, publication 525, whatever. So that way it helps me out. And then when I'm teaching people, or people are teaching me and they go, "Hey, Jerry, what about this?" I'll say, "Well, this is where I found the answer to the question." So anyway, I find that to be very helpful. Okay, so let's jump into a couple of income topics that most of us are probably aware of. And we'll start off with self-employment tax. And so when you're talking about self-employment tax, like I could tell people, you've got really three types of taxpayers. You've got wage earners, you've got investors, and then you have individuals who are self-employed. And that's really the three types of taxpayers. And then sometimes, for example, I'll use me. I'm a wage earner. I work at a college part-time. I'm an investor, and I'm also self-employed. And so as a self-employed individual, generally, you're going to pay what is called self-employment tax. And that's based on that Schedule C that you populate. And then when you look at the Schedule C, it's really an income statement. You're reporting your income. And in the VITA program, it's cash method or cash basis. And then we're going to report all of the ordinary and necessary expenses. And typically in the VITA program, we don't sit there and debate with the taxpayer about expenses. Usually it's a black and white issue. If there are questions, as I tell people, you want to utilize a number of documents. The publication 4012 is your go-to document. And then sometimes you're going to have to reach out to another document when you have an expense that you're not quite sure. But the bottom line is, at the end of the day, you've got net income. And if it's more than $400, then what happens is the computer, the software, will assess self-employment tax, which is approximately 15%. And that's above and beyond the individual income tax. And so sometimes you'll meet with typically a younger adult who's self-employed in some capacity, and they've not heard of self-employment tax. And so what I tell people, I say, well, there is a legislation that passed back in the 50s, and that's called the Self-Employment Contributions Act. And it's kind of like what we call FICA, that's for W-2 folks. Well, SECA is for folks who are self-employed. And you may be a wage earner and you may be self-employed. You might have two different gigs, if you will. Well, in the VITA program, because we work with individuals who typically have income $60,000 or less, if they've got that net income on their Schedule C more than $400, they're going to pay self-employment tax. And so that's the way I describe it. And then what happens is, for those of you who are on Social Security, you know that you've paid into Social Security. If you're self-employed, you paid into SECA. And then if you meet certain requirements, then when you reach a certain age, and generally it's 65, although it can go all the way down to like 56, you're eligible for Social Security. And then you can get that for the rest of your life. All right, so that's self-employment tax, and it's probably more of an education thing when people scratch their head and say, "What is this?" And then also we know if we've been involved in the program, the computer not only is going to assess or calculate that self-employment tax, it will also calculate that 1/2 self-employment tax adjustment. And that's a good thing for the taxpayer. That's something that's people will also ask about. So you simply explain it. You're going to be taxed about 15%. 15% of it, you're going to get that 1/2 self-employment tax deduction. All right, next we got notary income, and let me ask if I can. We got a bunch of people on the call here, and I know we've got some very experienced folks. How about we ask? Okay, we'll go with Barbara. I think Barbara is with AERP. Am I right, Barbara?
Oh, I turned to VITA last year.
Oh, okay. All right.
Yeah, our site's now a VITA site.
All right, so then you're a VITA person. So Barbara, can you explain just in very general terms what a notary is?
A notary is somebody who gets a license that can verify signature on a document.
That's basically it. Of course, there are certain requirements that each state has for notaries. You've got to go through training. You have to do the right thing. You have to make sure. I think in California, you get some type of either thumbprint or fingerprint, and then you charge money for each signature. So I don't know if you're going to get rich being a notary, but notary are important because they verify those signatures. So if you think about when you bought a house, or sometimes a notary is required. And this is not a bridge too far. You can find notaries all over the place. Sometimes they come to your house. Sometimes you go to a mailbox place and you say, hey, I need a notarized signature. They say, not a problem. They take your money, they take your thumbprint, and then they will notarize certain documents. So this is something that goes on every day of the week. And for people who are receiving notary income, there's no self-employment tax associated with notary income. And the only explanation I can give you, probably some lobbyist years ago in Congress, and Congress voted and said, nope, we're not going to charge any self-employment tax on notary income. I've seen that a few times, not a lot, but you may see that in VITA. Okay, one last thing regarding self-employment tax. If you were part of the program last year, there was a tax deferral for individuals who are self-employed and had to pay self-employment tax. And of course, we know deferral, you're pushing it off and then eventually you have to pay it. And what I did is a lot of people asked me, I said, yeah, it's part of the tax law if you want to do it. And if you have to do it. But generally, when you defer tax, what happens is people kind of forget about it. And then the next year they go, I've got to pay the tax. So when people ask my opinion, I say, you're going to do what you want, but I wouldn't do it. Now, if financially you have to do it, then that was available. But for tax year 2021, that is not an available option. All right, next, and this is a big one. I see this all the time. I saw this at the St. Killian's VITA site. I saw this at my Coastline College VITA site. And this is something that just, it's part of life. People go out and they buy things. Typically it will be a restaurant thing, or maybe you're tipping a valet driver. But tips in our society, it's almost gotten to the point, and this is just my opinion, where it's almost mandatory, if you will. But the bottom line is, when you think of a tip, you're providing extra money to someone because they have provided you with purportedly good service. And so, for example, I go to a coffee shop and I tip, I think I tip like 10% for a cup of coffee. I don't know if that's good or bad, but anyway, I give them a little bit. So what happens is there's various ways an employer and various ways an employee can handle tips. And so the bottom line is, when you have someone who is engaged in some type of that work activity and they're receiving tips, they've got to report those tips. There are some people out there who think because they receive currency, i.e. Federal Reserve notes, that this is something that doesn't go on a tax return. Well, I can tell you from experience as a former IRS agent that individuals who are compensated mostly by tips, they are an audit item. That means when they're brought in for an examination, there's a lot of questions that are asked. And in some cases, the agent will use what are called indirect income methodologies. We don't do that in VITA. The takeaway here is educate our taxpayers who are receiving tips. And so a couple things as far as education. Number one, if you are receiving tips, in addition to whatever pay you're receiving, you got to report your pay and you got to report your tips. And of course, there are certain exceptions to that. And so let's go through one of the exceptions. When you're talking about FICA, that's the Federal Insurance Contribution Act. We kind of call that Social Security. And so the rule is if you're receiving tips, you're going to have to pay FICA, i.e. Social Security on those tips, and you also have to pay income tax on those tips. Now, of course, if you're receiving less than $20 a month in tips, then you don't have to pay the FICA on those tips. You still have to report the tip income though. And there's various ways to do it. I share this with people because I meet a lot of people who receive tips. They do not report the tips to their employer. And I tell them, okay, number one, you've got to report it as an income item. And number two, you got to pay Social Security tax on that. And there's a form, and this is built right into the software, the form 4137, which is used by the taxpayer to complete, and they're going to report their Social Security and Medicare tax on those unreported tips. And that's really important because, again, we're not auditors, but if you ever get in front of an IRS agent and the IRS agent says, you know something, we're going to use one of these indirect methods to determine your income because you're not reporting your income that you've received on your tax return. That's not a good thing for that person because what will happen is most likely there will be additional income that will be imputed, and then there'll be tax that will be assessed on that income. And so again, I think this is an education thing, especially with our young adults. I know when I was young, there's just a lot of things I had no concept of. And then you bump into things and say, oh, that's the way we do it. And yeah, that's the way we do it. You want to report your income, and you, in most cases, are going to pay Social Security tax on those tips. And then here's another thing. When you look at a W-2, a W-2, a lot of times you're going to see what are called allocated tips. And when you're looking at allocated tips, it's shown on the W-2, but it's not shown in box one of the W-2. And box one, now that's the amount we call gross income. That's the amount that's reported on or in the software, and you're going to pay income tax on. And so again, have that conversation with the individual. Most likely it will be educational in nature. And then I always tell people if you're not reporting your income, and I bump into people all the time, I always hear the saying, in fact, it's a mantra with people. I ask them, how are you living? You're reporting $5,000 of income. You've got an apartment that you're paying X, you're paying school, you're paying food, you're paying insurance, you're buying clothing, you're taking trips. How are you living? And the response I get from people, they say, it's not easy. And I tell them, you know something, I'm a trained accountant, and that's called, it's mathematically impossible. And so here's the example I give people. You got no money in the bank. Let's say you're a young adult. Your living expenses in Orange County, California, not the most expensive place in the world, but it is expensive. So you got expenses of $40,000, you got income of $25,000, and you got zero non-taxable sources of income. Well, this is the math, as they say. You have to have an additional $15,000 to live, and that would be unreported income. Now, again, we're not going to audit people in the VITA program, but we want to educate them. And this is what I do at my site. When I see something like this, I have a conversation with someone and say, you know, I don't feel comfortable doing your return because it's mathematically impossible. And what we're doing, if I did this at my site, I'm setting you up for failure. Because if you do get an audit letter, i.e. correspondence audit or an office audit, the auditor is going to utilize their tools, which they've been trained to use. And if you've ever met an internal revenue agent, they go through a lot of training, and they do this every day as far as determining indirect income. So again, I think this education, I think it's important. I educate my people at my college. And when we go through, again, those VITA returns, I have that frank discussion with people. I don't think I'm a shy guy, but I just tell people, no, that's not going to work. And I'm not going to do your return. And my staff is not going to do your return because it's mathematically impossible. And then sometimes the taxpayers say, oh, yeah, you're right, Jerry. maybe I had additional tips. Okay, then let's go ahead and determine what you had. Let's pay your Social Security tax if you have to pay your Social Security tax, because you do not want to, as a young adult, to set yourself up for failure. And then what happens is you get called in a couple of years later by the IRS, and then your life becomes financially complex and difficult. So again, I just offer that. I'm not trying to be an auditor here, but I think this is something we want to share with our clients. I'm going to hesitate for a moment. There might be a question or two, and then we'll move on if we don't have questions.
I don't see any questions in the chat, Jerry.
Okay.
If anybody
right.
wanted to speak, just a reminder, I mute everyone as they log in, just so it doesn't sound crazy. So if you want to say something, you have to remember to unmute yourself. Okay.
And then another thing that we bump into, and this is very difficult for taxpayers, they'll say that they've been treated as a independent contractor, and they've been issued an information return, whether it be a 1099 NEC, that's November Echo Charlie, or they've been issued a 1099 MISC. And they say, hey, I really was an employee. I've seen this a lot at VITA sites. And I tell them, well, if you're an employee, then there's a couple options available to you. You can simply go back to your employer and say, employer, I'm an employee. I should be issued a W-2. And then a lot of times the employer will say, nope, we've issued the 1099 to you, and we treated you as a independent contractor, and so go away. And so that happens. And some people say, well, Jerry, what can I do? I said, and a lot of times it's a former employee now because they've left, they're not happy. I said, okay, well, that's easy. Now this is, you're going to have to do this because VITA is not going to do it for you, but you're going to have to complete what is called an IRS form 8919. And the 8919 is uncollected Social Security and Medicare. And so what that means is when the taxpayer completes the 8919, they send it to the IRS and say, hey, I'm going to pay Social Security tax on my income. I'm going to consider this wage and not independent contractor income. And then, of course, what happens is eventually the IRS sends a letter to the employer, says, dear employer, the person that was working for you, they claim they're really an employee. And so what we're going to do, we're going to have to determine that. And then if we determine it's an employer, you have to pay the other half of Social Security. And so that's something that I tell taxpayers that's an option. Some taxpayers say, well, Jerry, those are a whole bunch of steps we got to jump through. I'm thinking, yeah, that's correct. I don't know what to tell you, but yes, if you want to be treated as an employee, fill out the form 8919. And again, that's typically for someone who's left their employ, because again, they were treated as an independent contractor and there were no withholding, there's no Social Security, all of that. So that's another option, if you will. And then
Hey, Jerry, may I interrupt?
You may.
Yeah. Are you going to process the taxpayers 1099 as a business and then file the 8919?
Yeah, this is what I do. And this is what I recommend. When people come to you with a 1099 MISC or NEC, and they make that statement, I really should be an employee. I tell them, well, if you want to be treated as an employee, then what you can do, go back and get that W-2 or file that 8919. We will not file the 8919 for them. We will not. And then a lot of times what happens, taxpayers, they say, okay, then go ahead and treat me as an independent contractor and set me up for a Schedule C. Then we'll do that. But what I won't do at my VITA site, I'm not going to complicate things because it starts to become very complicated. There's a lot of steps. We don't have time to jump through those steps because we're preparing basic tax returns. I'll educate the taxpayer and say, go forth and multiply. That's on you. We don't have the time. There's so many things in the VITA program we simply can't do because we don't have the time and we don't have the staff that's trained to certain levels. So hopefully that answer, was that Art?
That was
Thanks,
Mel.
Jerry.
Mel.
Yeah, that's the best I can, and that's my best answer.
All right,
Jerry,
thanks.
There's one more question in the chat, Jerry. Bill had a question regarding the 2020 deferred tax. Does that have to be paid in 2021?
What I remember from that is the deferral goes all the way. I think there's a 50% deferral and a 50% deferral. And what I recall is that last payment has to be made in December of 2022.
Yeah, that's what I remember as well. Thanks.
All right. And then a couple things. And again, I've had these discussions hundreds and hundreds of times with VITA clients and many, many times with taxpayers when I work for the IRS. A lot of people say, well, Jerry, I receive tips and they're certainly not what was reported by the employer as far as allocated tips. What do I do? I'm thinking, well, this is on you. Again, we're not going to spend the time. We just don't have the time in the VITA program. But I tell them, go to IRS publication 531. And IRS publication 531 talks about reporting tip income. And if you're working at a place and you're only getting 5% tips and the employer says, now you're getting 8%, there are provisions for the taxpayer to report what they're actually receiving. And again, that publication 531 is going to do a really good job to educate the taxpayer. And yes, there are those, again, there are additional steps. And when I say those additional steps, I'm not trying to be flippant about it, but there are certain things that you just have to do when you're working with a government entity, i.e. the IRS. And sometimes you type up a letter and that'll answer the questions. Other times you're going to have to go back and forth, or you may have to appear in front of an IRS employee, explain things and show documents. That's the way it is. And I don't want to set people up for failure. And I don't want to give people unnecessary hope, but I want to tell them, this is what you can do. I try to educate them. Now it's up to you to go out and make it happen. And again, I can't guide you along because I don't have the time in my day. Now, if you need guidance, you could probably go to someone and find that someone, or in some cases, you might have to find a tax professional to help you out. But again, it's really on the person for that tip income that we talked about. Okay, enough about tips. Let's go to our tax and our early distribution. And we know when we are preparing a return and someone takes an early distribution from some type of tax deferred savings vehicle, typically it's like a 401k or a 403b or a 414, which is a TSP. There's different types of tax deferred vehicles. And so you're taking the distribution, you're going to get tagged with a penalty of 10%. That's the federal penalty. And then the state of California is 2.5%. And so like I've mentioned before, and you have probably seen this if you have been in the tax world for a while, when people take a distribution from, let's say their 401k and they're 30 or 40 years of age, what happens is it's very expensive money. And sometimes people don't care because they need the money. And sometimes at the end of the year, they realize, wow, this is very expensive money. Well, yes, it is, because if you take a distribution of, let's say $50,000 because you have no other income, then you're going to pay individual income tax on that $50,000 to the federal and state government. And you're going to pay that 10% penalty to the feds and 2.5% to the state. It is very expensive money. And so I always tell people, in fact, a lot of people ask me, both in the VITA program, in my practice, Jerry, what should I do? I said, well, I mean, we all need money to live. I got that. But if you can find sources of money other than cashing in your 401k, we're talking early now, that's probably the best way to do it. And there are many ways to do it, but it's up to you. You want to go out there and figure it out. Is it worth? But again, for our purposes, that distribution, and typically that early distribution, there are exceptions to the general rule, but typically if you're under 59.5, then you're going to get tagged for that 10%, 2.5%, and of course, tax on the distribution. And again, that would be a deferred vehicle. And when you hear the term deferral, all you're doing is you're putting off tax. That's all you're doing. So a lot of people in a 401k, they contribute for 10 or 20 years, they're deferring income, and then they decide to start taking that distribution. It's going to be a fully taxable distribution because of the deferral. And then a lot of people, they ask me, well, Jerry, why do I have to pay this 10%? Well, it's easy. Congress passes the tax laws, President signs it. It's part of the Internal Revenue Code. That's the code section for that early distribution. And then again, you probably have heard me and you probably have heard your other instructors talk about the general rule. What that means is generally this is what happens, and there are certainly exceptions to the general rule. There are exceptions to the general rule when it comes to credits, deductions, and income. And when you go into the body of the tax law, which is hundreds and hundreds and hundreds of thousands of pages, you'll find exceptions all over the place. And so what you want to do is stick with the general rule. And then if there is an exception that can benefit the taxpayer, then by all means, you want to invoke that exception. So for the distribution, some of the exceptions, there's a number of them, and you can go into your Pub 4012 and you can see those, but you have the disability exception, you have the higher education exception, and the first home purchase exception. And so have that conversation with the taxpayer. If someone says, hey, I cashed out my 401k, I am disabled, I am no longer able to work, I use these monies to live and to pay some medical expenses, then most likely that individual would qualify for that disability exception. And then you go into the software, you'll indicate the various codes, and these codes are right out of the publication 4012. Let's see. I think that pretty much covers the 10%. Unfortunately, what I see in the VITA program, I see again those young adults, 30, 35, 40, they cash out and they figure, oh, I did the same thing. I'm going to live forever, and I don't need this big account. I'll make it up later. Well, what happens is then they look in the mirror when they're 55 and they've got $6,000 in their 401k, and they go, oops, I made a mistake. And so again, this is what I do. I try to educate people as best I can, because I had a lot of great mentors in my life, and you're going to get old eventually, and you want to have money set aside. And if you have a tax deferred program, this may not be the end all be all, but it's a great way to save money. There's other ways to save money. You can invest in the market, you can buy real estate, whatever. But having a 401k, having a tax deferred vehicle, I think it's a good thing. And if you can stay away from cashing it out, I think that's a good thing. But again, some people have to. All right, enough about that. Let's go to our repayment of the first-time homebuyers credit. I have seen this a couple times in the VITA program, so I'll spend just a little bit of time to kind of give you some background. So what happened is this credit was really a loan. That's what it was. Back in 2008, you bought your personal residence, and you took a credit, basically a loan, and the maximum was $7,500. And then the requirement was in tax year 2010, you had to start paying it back. And so if you have someone who took this credit back in 2008, then yes, they're going to have to pay that back. Your page H2 talks about it. And if you have a married couple, you're going to have two Form 5405s to complete that credit, or we'll call it the repayment. And again, I've seen that, I think, 2 times in the VITA program. All right, before I go on, any questions?
Yes. Do they, if you have that first time home buyer credit, does the IRS or somebody send some kind of document to the person to tell them that they owe a repayment of it?
You know, not to my knowledge, I have not seen that. What I am aware of, though, is when you file a tax return, the IRS establishes what is called a master file for you. And there's a thing called a master file transcript, or an MFT. And so what that means is you have an account with the IRS for that particular tax year. And then what happens is, as you file your returns and you have a new account for a new tax year, so what happens is, if the IRS is looking at this particular repayment, you've taken the credit, let's say, 13 years ago, 12 years ago, and then you're not repaying it, well, that could generate a what is called a correspondence inquiry or a correspondence audit. And you'd get an automated letter and say, dear taxpayer, you took this credit back in the day and you're not repaying it. What's the deal? That could happen because, again, there are numerous programs that the IRS uses to prompt people to make payments. So, but again, I'm not aware of, other than that letter, some type of notice going out and say, hey, it's time for you to repay this.
Hi, Jerry. This is Omid. So I just wanted to share my experience that I had 2 or 3 tax returns rejected actually because the taxpayer failed to report his $500 or her $500 repayment. So the IRS would not process their tax return until that is computed on their tax return as well.
Oh, that's good to know, Omid. Yeah. And when, of course, when you have a rejection, what that means is, and you got to go back and fix it, or you have to paper file. Yeah. Now, I have not heard of that, Omid, so that's good. Omid, can you say that again? I think that's a good nugget of information.
Yes. So when we submit the tax return to the IRS, these people who have a repayment and did not pay it, their tax returns gets rejected with a code mentioning that this person had a first home buyer or whatever this is mentioned, that they need to basically process that in their tax return. So then we call the taxpayer and tell them, oh yes, I forgot. So yes, that's what happens. Their tax
Very good.
not go through basically.
So that sounds like the IRS is coming up with more and more sophisticated programs. So I guess that's a good thing for the Treasury. And that's just a step that the taxpayer has to go through. All right, thank you, Omid, appreciate it.
Yeah, sure.
Okay, let me go to our next slide.
Whoops. The slides ended.
You didn't take control, did you? Did you,
I
Omid? All right, let me go back to our slide here. Okay, Sean, can you see the earned income
Yes.
credit slide?
Yes, I see it, Jerry.
Okay, so let's talk a little bit about earned income. This is something that we see a lot in the VITA program because we have low and moderate income taxpayers, and a lot of them are eligible for the earned income tax credit, both the federal one and the state one. And then, of course, we do know that the federal and the state earned income tax credit, you think of a dog and a cat, they're 2 different animals. There are some similarities, but again, you're talking about 2 different types of earned income tax credit because the state is less and there's certain things that the state does that the feds don't do and vice versa. So let's talk about what is earned income. When you think about earned income, most of us in our lifetime have had some type of either self-employment or we were a wage earner or both. And so if you're receiving wages, you have earned income. If you have self-employment, you've got earned income, and that would be that net income that appears on your Schedule C. And then, of course, tips as a wage earner, sometimes it's run through the W-2, which means it's reported in box 1. Sometimes the taxpayer has to fill out that form 4137 that we talked about and then report their tips. So again, that's earned income. And then this is what is not earned income. Interest and dividend, typically called portfolio income. That's not earned income. I was talking to a young adult the other day, and he actually went through one of my tax classes, and I asked him what dividends were, and he couldn't tell me that. So when you think of dividends, all it is typically you've got shares in a corporation, and then the board of directors decides to pay out some type of dividend because they've got earnings and profit, and that's typically what we think of dividends. If you have money on deposit at a credit union, sometimes the credit union will call it dividends. That's really interest income, and you might remember that from your reading. So again, dividend income, and keep in mind, I think we've mentioned this before, sometimes you're in a dividend reinvestment plan, you're still going to get a 1099 DIV, even though you did not take actual receipt of the income, you had constructive receipt of the dividends because you instructed the corporation to purchase additional shares. Again, it all comes out in that form 1099 DIV. Social Security benefits, not earned income, unemployment compensation, not earned income. And then alimony. I didn't see alimony in VITA for many years, and now I'm starting to see a little bit of alimony. Alimony is simply monies that are paid by typically an ex-spouse to another former spouse, and it has to be ordered by a judicial official. Sometimes I bumped into this, people are giving money to their ex and there's no court order. That simply means they're a nice person. That's not alimony. And then, of course, alimony, the old rules before 2019, if you're receiving alimony, that's going to be a taxable event. If you're paying alimony before 2019, you can take a deduction. The new rules that have come out for tax year 2019, 2021, for those recently divorced, i.e. after 2018, alimony is not reported on the tax return, and you cannot take a deduction for alimony paid. And all of that's written up in your publication 4012. Okay, so let's talk about eligibility. And again, we're talking about the earned income tax credit that appears on a federal tax return. You've got to have Social Security numbers. And I've had this discussion many times. People say, Jerry, where do I get a Social Security number? Well, that's easy. If you're eligible to receive one, and not everybody is, you would apply to the Social Security Administration. And what happens is they're going to issue a Social Security number to you. And then you're going to have that card, and that's the card that taxpayers show when they come to our VITA site. And then you have to be a U.S. citizen or a resident alien. And of course, a U.S. citizen, I think a couple ways. The ones that I'm familiar with is you're born in the U.S. And the general rule is when you're born in the United States, you're a U.S. citizen. There are exceptions to that. So if you're a diplomat and you've got a baby that's delivered in the United States, that baby is not a U.S. citizen. We're talking, let's say you're a diplomat from England or Morocco, your kid is not a U.S. citizen. So again, if you're born in the U.S. and your parents are U.S. citizens, you're a U.S. citizen. If you come to the U.S. and you say, hey, I want to be a resident alien, then you have to go through the immigration service. You got to fill out a form, you got to pay a fee, and then abracadabra, you're designated as a resident alien, and then you're given a card. That would be a resident alien. So you got to meet those rules. Investment income, I mentioned this a few weeks ago. This has changed substantially. And so if your investment income is $10,000 or less, and in the VITA program, a lot of our people, they have investment income, maybe a couple $100. But again, this threshold has gone way up. So you think about it. Let's say you've got a bank account. In order to generate interest income of $10,000, you have to have probably multiple hundreds of thousands of dollars. And chances are you're just not gonna use the VITA program. But again, the threshold's gone up, it's there, and that will benefit some of our taxpayers who have investment income of multiple thousands of dollars. And then of course you can't fill out that form 2555. We don't do this in our VITA program unless you're qualified under the international module. And all the foreign earned income exclusion is if you meet the rules, you can exclude a certain amount of your income on your U.S. tax return. And so the example would be, I'll use my sister. She was living and working in Holland. She called me up. She goes, hey, Jerry, I got to pay tax to the people over here in Holland. I said, okay, yeah, that makes sense. What do I do on my U.S. return? I said, that's easy, sister. You're going to fill out the form 2555. You're going to report your income that you received in Holland, and you're going to subtract, at that time, is about $100,000 on your U.S. return. And so that's what the exclusion is all about. It's not automatic. You have to qualify. And then another rule is you can't be a qualifying child of another person. And then, of course, the election. We saw this election last year. And so for tax year 2021, if someone chooses to use the earned income that they received in 2019, i.e. to generate a larger earned income tax credit, that's something that's something they can do. And so that would beg a question when you're talking to the taxpayer who's eligible, what type of earned income did you have? And most likely they'll have a return, and maybe the return for 2019 is in the system. And then there's other rules, and this is something we go through, and I would encourage you to really study the publication 4012 or get into that publication 596. That does an excellent job talking about earned income credit. And you have to, if you have a qualifying child, then you have to meet the age, relationship, residency, and that joint return test. And when you hear that joint return test, what it means is someone is filing a tax return that would be a young adult, and that young adult is married probably to another young adult, and they're filing a joint return only to get a refund. And that's what that means. And then this is another big change. You're going to see this for 2021. You've got what are called rules for individuals who do not have a qualifying child. And so you probably remember the old rules, 25 years of age to 65. And if they were younger than 25 and they didn't have qualifying children, or they were older than 65, they would not be entitled to the earned income tax credit. So those rules have changed. So the general rule is 19 years of age. So that's a good thing for the taxpayer. And there's no upper age limit. So if you have a senior, let's say that senior is 67 years old, and they are working, they have earned income, and they meet all the requirements, then they're going to be eligible for the earned income tax credit. And this is something you might want to make a note, certainly in your publication 4012. Generally 19 years of age, there's two exceptions to that. It's called specified student. They've got to be 24, or in some cases, a foster child, i.e. now we're talking about a foster child who's now an adult, age 18, they can be eligible for the earned income tax credit. And I've met a lot of foster, I'm not going to call them children, foster kids, and they've reached 18 years of age. That means they're an adult. And in this case, they can get that earned income tax credit if they meet all the other requirements. So I think this is a really good thing for a lot of taxpayers, and we're going to see this this particular season. And then the earned income or the AGI limitation, this is something you're not going to have to memorize. It's all built into the software. But sometimes you're going to get questions and people will say, why am I not entitled to the earned income tax credit? And you can say, well, you can see here on page I-2 that based on your income, based on your AGI, and based on your filing status, you're either eligible or not eligible. But again, no reason to memorize it because it's built into the software. Let's see. And then again, the Pub 596, I'll give you a quick war story. Years ago, I had to prepare for an earned income tax credit presentation. And so I knew a little bit about it because I had some training, and I actually dissected and digested that publication 596. And you will be loaded for bear, as they say, if people ask you questions, if you have a working knowledge of the 596. It's a really good publication. It gives you the general rule and then certain exceptions. All right, I think at that point, I'll hesitate for a moment and then take questions, and we'll take our first break.
Jerry, there's one question in the chat from Paul Abrams. Wants to know if you can discuss what we do for alimony for divorces that happened before 2019.
Yeah, the short answer there is individuals who have been divorced, and this is the general rule, there are exceptions, but let's say they were divorced before 2019. Let's say they got a divorce in 2015 or 16 or 17. What that means is the individual receiving alimony is going to report that as a taxable event on their return, and the person paying alimony is going to take a deduction. And that's the general rule for those divorces many years ago. And so if you might have a question from someone pop up, say, wait a second. So it really depends on the date. And the answer is yes, Congress made a determination. And so you do have, I don't know, I'll call it a two-tiered system, depending on when you got divorced. And that's just the way it is. So yeah, you want to do that. And so what I would do when I'm talking to people who've been divorced and they're receiving alimony or paying alimony, I ask them, okay, tell me when you got divorced, has this thing been modified? And when you modify a divorce agreement, well, you have to go in front of a judge. And so that's what I would ask. But the short answer is, yeah, if you got divorced before 2018, you got to report that income and you can report that deduction. And then this is also important. I've seen this, as I mentioned before, it has to be pursuant to a judicial order. When you're doing something voluntarily, and people do voluntarily pay others, that is not alimony. It has to be pursuant to a judicial order, a court order. But hopefully that helps you out, Paul.
All right, and then Barbara had a question, said if the alimony reporting for California different than federal? I think we're going to address that next week, right?
Yeah, and I did some early reading on that. What I remember doing this, I don't have my notes in front of me, is California does not conform. And so what that means is on the California return, you're going to report alimony received, i.e. you're going to report it as a taxable event on your California return. And yeah, we're going to talk about conformity and nonconformity issues. And you see that from time to time, not only in VITA, but on other returns. And people say, well, why do I have to report it? And again, I'm not being flippant. I'm thinking, well, California has different rules. They go by the Revenue and Taxation Code. The IRS goes by the Internal Revenue Code. And that's the way it is. I can't tell you any different. But yeah.
Are you able to read the chat? Because there's a very long question that has a scenario.
All right, let me see if I can digest it. And if I can't do it in a second or two, then
Maybe
we'll
after
take
the
it
break.
later. Okay, let me read it real quick. I'll read it aloud. Without a court order, a former spouse pays a monthly amount to his or her spouse, and the total amount is 20,000. So the remaining 5K, after considering annual exclusion amount of 15K, is taxable income for the recipient. So the best answer I can give you, if you have someone paying money to someone else and you do not have a judicial order, that is not alimony. That is not. And so the answer is you're not going to report that as income on a return, and you're not going to be able to take a deduction again for those older divorces. So that's the best answer I can give you right now.
So it's just somebody's a really nice person.
Yeah, and I actually saw that in Living Color. A guy said, "Hey, I'm paying my ex-spouse X number of dollars." I said, "Where's your court order?" He goes, "I don't have one." I said, "Okay, then you're a nice guy, and what you're doing is you're giving your former spouse a gift. And if you receive a gift, we're talking about whether it's $2 or $2 million, a gift, a bona fide gift. There's no tax consequence to the recipient." And he goes, "Oh, I guess I should get a court order." Up to you, but I'm just telling you the rules. Okay, I think this is a good time to take a break. So how about we take 10, Sean?
Sounds good, Jerry. We'll take a break for 10 minutes. It is now 9:55, so we'll have everybody back at 10:05. Okay, 1 minute warning. Break's almost over. Hey, Jerry, I was looking at the YouTube channel and I see you're getting a couple hundred views. So you're a celebrity now.
Wow. Sean, I got to tell you a story. Years ago, I did a cable television thing on taxes, and my son was probably like 3 or 4, and he was ecstatic. He saw his old man on TV, and then I had to break it to him later that, yeah, only about 20 people were watching.
Wow, you're 10 times as famous now. Okay, it's 10:05.
All right, well, welcome back. So we're going to talk about refund and amount owed. And if you are an experienced VITA volunteer, you most likely have seen this many, many times. But we'll talk about some general rules, and then hopefully you can get some input from some of the volunteers, because they probably have done this in some cases, maybe more than I have. But when you're talking about a refund, and generally in the VITA program, a lot of our taxpayers are going to get a refund, which is great. That allows them to obviously pay bills, buy diapers, and things like that. And so that's really, for me, that's probably one of the biggest joys that I see is preparing a return, doing it correctly, and the taxpayer walks away with a large refund. Hopefully they get the earned income tax credit. And so it's a good thing. It makes me feel good for them. So what happens is a lot of times taxpayers, they simply want monies to go into a bank account, one account, perhaps a checking, perhaps a savings. If they want, they can actually allocate, and if I remember correctly, up to 3 accounts, but practically they'll probably put some money in their checking and some money in their savings. And of course, if people ask me, and sometimes they do, Jerry, what should I do? I said, well, it's your money. You might want to take advantage of perhaps maybe saving some of this money. Certainly you're going to spend the rest. So that means if you're going to spend the rest, you're probably going to put it in your checking account. But again, you can do the allocation to different accounts. And in page K3, it talks about that. And if you want to purchase savings bonds, I think I've seen this once or twice in the VITA program. And savings bonds, it means you're lending money to the government, and you've got a bond. And if you want to cash that bond out eventually, you can send it to the government, or you can go down to a bank and you can cash it out. So I think, like I used to buy savings bonds. I actually still have some savings bonds. And so that's probably not a bad idea either if they want to do that. But again, it's up to the taxpayer. Another thing that taxpayers sometimes will do, they have a refund coming to them, and a lot of times it may be a small refund, and they decide, I don't want that money to be sent to me or dropped into my account. I simply want to roll that over to tax year 2022. And then that way, if I owe, take that amount and apply it to what I owe. But if you do that application to the next tax year, you can't change it later. It's set in stone, if you will. Now, this is something that we see on every return. And if you're preparing a return or reviewing a return, you probably run through this. So you got to know the bank name, and most people know their bank name. Some people don't know their account number. If you ask me, Jerry, what's your account number? My answer would be, I don't know. I got to check. I haven't memorized it. And that's going to be probably pretty typical. Most people will have their bank information on their iPhone, and so they're able to access that. And then that routing number, which, if I remember correctly, is American Banking Association, or it might be a Federal Reserve thing. But there's a routing number and a bank account number. And sometimes people don't know the difference. And so they look at their check, if they have checks, or if they have some type of account information. And sometimes they call the bank and they go, hey, what's the routing number for that financial institution? And so those are things that you want to hammer out. because this is for your direct deposit. And I think, I don't think this is a big issue anymore. Every once in a while, I'll bump into people and they'll tell me, Jerry, I don't want the government to have my information. I tell them, the government already has your information. If you've opened up a bank account, credit union, you got a savings account, checking account, whatever it is, that data was collected by the bank or the financial institution. They've got your name, they've got your social security number or your ITIN, they got your address. And so the government, i.e. the Internal Revenue Service, already has this information. And so it's not a secret. Of course, what we do when we collect that information, we want to keep it secure because obviously that belongs to the taxpayer. And we're only collecting that data to either make some type or to ensure some type of refund goes into their account. And then, of course, if someone owes money, they can also pay, and they can pay. Obviously, they have to provide all that information. And this is something that I don't know if it was new last year. I simply can't remember. If you got these prepaid bank cards, you can actually use them, and you can reload them. And there's a discussion on page K2. Again, I don't think I've seen this in the VITA program. Most people either have a refund, or if they owe money, they want money to come directly out of their account, or in some cases they say, I'll write a check or pay later. I will say this, if you owe money to the IRS, what you want to do is you want to pay as much as you can, as quickly as you can, so you can avoid the interest. And there are different ways to do it. Some people ask me, what are the ways? Well, I tell them you can write a check, you can go down to an office and you can make a payment. You can pay with a credit card. And then when I tell people you can pay with a credit card, I'm thinking there are fees associated with that. And then when you put money on your credit card, what you've done now is you've got a debt on your card, and chances are you're paying interest to the credit card company. And so it depends on your situation. That may or may not be something that you want to do. And so those are ways to pay it. Another way, a lot of people say, I can't pay what I owe. All right, another way to do it is go into an installment agreement. And in some cases, you're going to have to pay an installment agreement fee. And then you can do this all electronically on the IRS website. But I think the mantra is, or the message is for our VITA clients, pay what you owe as quickly as you can. Because if you've got a tax debt hanging over your head, we know this in previous experience, that tax debt is going to be there for 10 years. We're talking about the federal tax debt. And the IRS most likely will find you in that 10-year period and collect that money or attach an asset of some kind. So again, just tell people there's ways to do it, but just pay as quickly as you can and avoid the interest and then the troubles later. And then this is something that you see in the VITA program, people who are not making their tax payments on a regular basis, which means they're not making their estimated tax payments. And so you do have self-employed people in VITA. And what happens is they're making money, they're paying their expenses, and they're not making any estimated tax payments to the federal government or the state government. So what happens at the end of the year, they owe $14,000 or $12,000, and they go, well, gee whiz, now what do I do? Well, I would encourage them to meet that 90% rule. That's the general rule. Pay as you go during the year. They're called quarterly tax payments or estimated tax payments. And that way you can avoid that big end of year thing where you have a VITA volunteer and say you owe X number of dollars because you haven't paid your tax during the year. Again, primarily for self-employed individuals, but sometimes you can bump into a wage earner who has insufficient withholding and they're not meeting that 90% rule. If they don't meet that 90% rule, the general rule is they're going to pay what is called an estimated tax penalty. We typically don't calculate that in the VITA program, which means they're going to get a letter later. So when I work with our VITA clients, I tell them, yeah, everybody's different. I got that. But once you know that you owe money, pay it off as quickly as you can, and then get yourself set up for the next tax year where you're making those estimated tax payments. So again, at the end of the year, you don't get clobbered with the large tax bill. That is a big downer. I've talked to a lot of people. It's frustrating for them. It's depressing for them. So they simply want to get set up for what are called quarterly tax payments so they can pay as they go. And I think that's probably one of the best educations you can give certainly a self-employed individual so they can avoid this these troubles year after year. And then every once in a while you bump into people, they say, I'm just going to pay at the end of the year. Okay, you're going to pay at the end of the year, and then you're going to most likely pay an estimated tax penalty because you haven't met that 90% rule, meaning you're paying 90% of your tax liability during the tax year, pay-as-you-go system. So I'm going to open it up to any stories or any useful guidance about refunds or amount owed at this point, Sean.
Okay, I have a story, but first there's a question about prepaid cards, and I think your answer is going to be that we have to look it up. But does the prepaid card have an account number and a routing number?
Oh, that's easy. I don't know. I've never used a prepaid bank card. I don't know if they're good or bad, but I don't know. But I do know one thing. If you go to the Pub 4012 or the IRS website, you're going to get a detailed answer.
The 4012 says you have to have the routing number and account number for a prepaid card.
Bingo. Very good. Very good.
Also, it says that the bank name is optional.
And let me ask you, since I've never used one, I don't think I've ever seen one. Do you get a prepaid bank card at your bank?
Well, it's a prepaid reloadable card. Yeah, you can get those. I mean, you can get one from businesses too,
Okay.
Amazon or.
Okay.
But they're all issued through banks, just like any credit card is.
But I don't know how you find out what the routing number and the account number is.
Yeah, you're gonna probably have to make some calls. Yeah, I've never seen that at a VITA site. I mean, if they exist, that's great. I would go to Hub 4012, and then you might have to ask some more questions.
Okay, Jerry, Natalie has a comment that she's regarding the first-time home buyer credit. There was somebody had asked if you get a notice and the IRS has a first-time home buyer credit account lookup tool on irs.gov, where if you're not sure how much you still owe, you can just go right in there and enter the information they ask for, and it'll tell you the remaining balance and the amount you have to pay this year.
Very good. Yeah, I did see that, and that's an excellent comment. And that kind of probably begs the statement when you're filing your returns. And I got it. People are not going to save every piece of paper or every piece of electronic data they have, but it's probably a good idea. It's not required, but it's probably a good idea to save your tax returns in some file. And in some cases, like the repayment of the first-time homebuyers credit, or if you have a personal residence that you've owned for 20 or 30 years, it's probably a good idea to keep your returns going back more than 3 years. So for example, let's say you purchased your home and you got a settlement statement, and it's probably good to keep that settlement statement when you bought your home 25 years ago, because it's going to talk about what is called cost or basis. And then other records you're going to keep for many years. It could be perhaps maybe you put in that swimming pool 14 years ago and it cost you $50,000. That's another item that's going to go to basis. So I think it's good to keep records. Of course, you want to make sure you're keeping records for a particular purpose, but that's a good point. All right.
So I got one more story for you, Jerry, on the tax refunds and amount owed. Well, I had a client last year was very excited because he was going to get a really big tax refund, and called me up a couple of months later, had not got his refund in it. It turned out he owed taxes in 2018 and had never wrote that check to the IRS, and they have a weird way of not giving you your refund if you owe them a lot of money.
There is what is called a refund offset program, and I've talked to a lot of VITA clients that go, hey, I'm not getting my refund. And then we start doing a little research, or they start doing a little research, and they go, oh, that's right, I owe the federal government for this, and the IRS is taking my refund. And that's an important point. I have some people say, okay, I'm not going to file. I say, well, that's a bad idea, because if you have a filing requirement, you should file. If you have a refund that will be used to satisfy a federal liability, then file your return, and eventually you're going to pay off your liability. If you stick your head in the sand, that's probably a really, really bad idea, because if you have a federal tax liability, it's going to hang over you for a long time, and it may make your life difficult. i.e., let's say you apply to be a U.S. government employee. Well, one of the questions will be, do you owe the U.S. government money? And if you do, then you got to come clean. So yeah, it's a good idea to not only keep records, but also it's a good idea to file, and it's a good idea to pay what you owe. All right. Any other questions, Sean? Otherwise, we're going to move on.
No, keep going, Oliver Wendell Holmes.
Oliver Wendell Holmes. I like that guy. Okay. Let's see if I can. Hold on a second. Let me go ahead and reload this. Okay, let's jump into the form 13614C, and we know that's the intake and interview and quality review sheet. That form is updated every year, so there are slight changes on the current one that you most likely have seen in your training if you've gone through any of the training. So here's some things that you want to consider. These advanced child tax credit payments that a lot of people have received, that's something that you're going to have to ask the questions about. And some people are going to say, I don't remember. I'm one of those guys. I don't remember. So I have to go to my bank account and I've got to look for those treasury payments that went in, and then it's going to jog a memory. So you do have to ask about that. And again, it's something that you're going to utilize on your software for 2021. And then the stimulus payments, and I've mentioned before, you've got the California stimulus payments, and then you've got the federal stimulus payments. And so some people will get those mixed up. And so you simply explain the federal one comes from the US Treasury, and that third stimulus payment, everybody didn't get it. A lot of people did, but not everybody. And then some people got the full amount and some people did not. And as I mentioned before, some people say, well, Jerry, why is that? In fact, I had one of my pro bono clients, not a VITA client, but a pro bono client. She says, Jerry, I didn't get one. I'm thinking, well, I don't know what to tell you. You didn't get one. And so what we'll do is we'll go ahead and ask the IRS why you didn't get one, and then go from there. But again, you want to make sure you ask them how much their payment is, and did they receive that third federal stimulus payment, because that will appear on the tax year 2021 return. And then if you have the 13614C in front of you, or if you don't, on page 1, you go to the lower right-hand corner, and there is a gray section, gray in color, and that's the section that your preparer wants to complete. And again, that's on page 1. So as you perfect the intake sheet, because the taxpayer fills it out, and you're going to go through it as a preparer, and you're going to look at the responses from the taxpayer. And then a lot of times you're going to ask follow-up questions. You're trying to perfect that because that's your lead sheet. And sometimes taxpayers are unaware of things. And so you're going to help them along. Other things, and I always, when I want to look at the lead sheet, the intake sheet, and I'm asking questions, I always ask people open-ended questions. I say, well, tell me about your income in tax year 2021. And sometimes people say, well, that's not taxable. I'm thinking, well, okay. If you tell me about your income, I may be able to tell you what's taxed, what's not taxed, and what's taxed in part. And so humor me, tell me about all of your income. And then sometimes people say, well, Jerry, I got a loan from the bank. I'm thinking, okay, well, loans are not income. Well, Jerry, I worked over here and I was an employee, but I didn't get a W-2. Okay, well, then you have an issue there, but that's income. And so you want to confirm that. And sometimes it's really easy. And sometimes people say, Jerry, I got a settlement from a court decision, and I got this notice for $350. Is this taxable or not? Well, then I would ask them some follow-up questions. You may have to get into the IRS publication 525, and you should be able to answer that. Because again, in our program here, we got a lot of smart people. I've been in the parking lot there, and I've talked to a lot of smart preparers. And so we collectively, we can find the answer pretty quick. And then as far as your federal and state estimated tax payments, I am seeing this more and more in the VITA program. I don't know if it's because of self-employed people or what, but yeah, when people are making those payments, a lot of times they're going to have a list of checks or maybe some type of document, and it'll evidence the payments that they made. And of course, we go right into the software and we indicate the estimated tax payments that they made. And then you might remember the term, the global carry forward. This is how I understand it. If someone has a different understanding, please jump in. What that means is we're not requiring the taxpayers to sign that permission, if you will, for global carry forward. What it does, it makes the taxpayer and the tax preparer's life easier, because once a taxpayer agrees to that, then you go to whatever site you're going to get your return done. And that data then is, i.e. from the previous year, is carried forward. It makes it easier for the preparer. And some people, they read through it and they say, I'm not interested. Okay, fine, you're not interested. But I always encourage people to do that, because in the VITA program, we keep that data secure and we don't share it, obviously, with the general public.
Hey, Jerry, I think also the global carry forward is if the client goes to another VITA site, the other VITA site would be able to pull up their return, as opposed to them not sharing that information.
That's correct. And the way I like to put it is the big computer in the sky, the big VITA computer in the sky, all of that data then is managed, it's archived by the tax slayer people. And so the VITA folks can do that. Once the carry forward is agreed to, then yes, wherever you go, that data can be carried forward. Again, it just makes it easier for people.
Jerry, do you know if the carry forward goes between VITA and AARP sites?
I think it does, but I couldn't swear to that. I'd be lying to you, but I think it does, because when you talk about AARP is a different animal than VITA, but AARP, not all of them, but the vast majority of AARP tax aid site, they're going to use the Tax Slayer Pro, i.e. the VITA provided software.
And then there's a question popped up in the chat, came to me privately, which was, we talked about the 90% rule, but you never really specifically addressed what is that 90% rule.
Oh, sure. Yeah. Like I mentioned, you're paying 90% of your tax liability during the year. That's the general rule. So for example, let's say your tax liability, your total tax liability is $10,000. And what that means is during the year, you have to pay 90%, i.e. $9,000, to avoid that estimated tax penalty. And most people do it through withholding. But again, like I always say, everybody's different. Every tax return is different. So for example, I'm a wage earner and I've got withholding on my wages, and I still make estimated tax payments. And then of course, in some years, I have more money that I earn as a self-employed individual. And so I make those estimated tax payments. And this is something I actually had a discussion with a person, and they said, Jerry, last year I was whatever, $200 or $300 off, and tell them, the word estimated, and again, I'm not being flippant here, the word estimated, look it up on the dictionary. It means you're trying to make a projection. And sometimes you're going to be within a couple $100, and maybe you're going to be within $500. That's all it is. You're estimating your income for the year, and then you're calculating those quarterly payments. And so that's what it is. And the whole intent behind that is to meet that 90%, which is, if you're doing an estimate, you're doing a good faith estimate of your income, you should be okay. You should be able to hit that 90%. And again, there are exceptions to that general rule, and it's pretty involved. We're not going to talk about the exceptions here.
Does that include also your self-employment tax then, that you have to pay 90%?
It does. It's your total tax liability. So when you go to a tax return, I forget what line it is for 2021. It says total tax. I think the term is total tax. It's bolded font. And what that means is your total tax liability for the year. And so again, using me as an example, this year I got withholding for my wages. I make estimated tax payments for my tax practice. And then I'm in the stock market and I have to make estimated tax payments because I've sold some capital assets and I've got gains there. So yeah, you got to come up with that estimate. And I did an estimate for a client a couple months ago. It was involved. It took a couple hours to do it. And I shared the information with the client and said, okay, based on the information you provided, this is going to be your income. And these are your 4 quarterly payments you got to make. Okay. Anything else, Sean, before we move on?
No, that was the last question, Jerry.
All right, good stuff. So just a couple things, and I think everybody knows this unless you're fairly new or new to VITA. When you hear the term information return, what that means is you've got IRS documents like the W-2, the 1099, the 1098-T, the 1098. Those are information returns. And those information returns typically, not all the time, will have the information that you need to prepare the return. If they are in error, then of course the taxpayer should go back and try to obtain a revised one. And in some cases, that's it. They're stuck with the one they got. And so that's when you do the interview and you ask them questions. And so information returns are important, but sometimes they don't have all of the information, or sometimes the information is incorrect. And so again, asking those follow-up questions. The 2020 return. What I saw in St. Killian's, a lot of people were returning clients, which is fantastic because the data is there in the software. But you do want to ask a number of questions to include, yes, you want to secure that tax return from 2020. And you also want to ask about the state taxes they paid, because about 10% of VITA clients itemize, not a lot of them. And the ones who itemize, they generally deduct their state taxes on their tax return, i.e. State income tax that they're paying. And a lot of them take what is called a tax benefit. And so if you take a tax benefit on your 2020 return and you subsequently get a state tax return in 2021, then if you've taken that full benefit, that tax return is a taxable event on your federal return for 2021. And so you can determine that by looking at the Schedule A for the previous year. But again, they have to take a full tax benefit. And when you get into the software, you got a worksheet, and so you'll answer the questions. But again, you've got to get that 2020 information. And then this is something that I actually bumped into this, I think about a year or so ago, worked on a return. This was one of my paying clients. And for some reason, I either glossed over the capital loss carryover or just kind of blanked out. Client called me up and says, "Hey, Jerry, I had a capital loss carryover in the previous year. Should it appear on the current year?" I'm thinking you're absolutely correct. So that's something you want to look for. Sometimes people will sell their capital assets, i.e. their shares. They get a loss, and then the carryover goes to the next year if they haven't used up the loss. And yeah, you want to bring that over to the next year and enter that data. And of course, you're differentiating between the short term and the long term, and that'll be stated on the Schedule D as in Delta. So that's something to look for. And then oral testimony. A lot of people are going to tell you stuff that is fuzzy. And so I'm the type of guy, and I think some people say, "Hey, Jerry," in fact, I had a client one time who fired me. I'm thinking, all right, you get fired from time to time. He says, "You ask too many questions." I'm thinking, well, the reason I ask questions is I want to make sure that we're getting your return correct. And I don't want to embarrass you. I don't want to humiliate you. I just want to ask these questions because I think we want to make sure that all of your answers are correct and complete, so we can do a return for you that is correct and complete. And so that's why I think it's really important to ask questions and again, confirm a number of things. But again, don't embarrass them. We don't engage in any type of disrespectful behavior, but just follow up, ask the questions. I think it's really important. And that's saved me. I have a lot of clients, paying clients and pro bono clients and VITA clients. After I ask these questions, it triggers things. They say, "You're right, Jerry. I forgot about this. I forgot about that. I did pay this, so I do have this particular deduction." So again, it's important. And then this is something we all know from a VITA experience. Taxpayers, they give us the paperwork, and we prepare a return for them. And we tell them, "Here's your return. Sign the electronic authorization." And you want to keep in mind on the Form 1040, it says, under penalties of perjury, you're preparing a return and you're telling the IRS, "This is the best information I have." And if you're signing a return, if you're signing an authorization, you're omitting income, you're taking advantage of a credit, taking advantage of a deduction that you're not entitled to, and you're aware of that, well, that means you're engaged in perjury or you're lying. And a lot of people do it. And if they get caught, then of course, the IRS then assesses penalties and interest. And again, we just want to make sure that taxpayers are aware it's their return We're doing everything we can to prepare a correct and complete return, but we need their help. We need their help. And again, you got to ask follow-up questions. And then this is something, and I leave it to the site coordinators, and you want to be comfortable with the return prep. If you don't feel comfortable, then don't do it. That means someone else would take the return, or in some cases, the site coordinator will say, we don't feel comfortable for whatever reason. Maybe we've made a determination that it doesn't look like you're reporting all your income. And then the taxpayer then is gently ushered away and say, go out and find someone else. I had a client, a pro bono client, asked me some questions. I said, we're not going to do that. And she said, well, how do I do it? I said, go out and find yourself a paid preparer. You've got a complicated return, and I don't have the time or the energy to prepare your return. I'm just not going to do it. It'd probably take me 2 days to do it. Go out and find a paid practitioner and pay the $2,000 or $3,000 to get it done. But again, comfort, typically it deals with someone who's not reporting their income. They're reporting some type of deductions they're not entitled to, or they're reporting a credit they're not entitled to. And again, have that conversation with the site coordinator, and you're going to bump into uncomfortable situations. It doesn't mean that you're going to kick them out the door. You're probably going to have a conversation with the taxpayer. And again, we're not going to yell at them. When I look at taxpayers and I just say, I'm not going to do it, and this is why I'm not going to do it, and here are your options, and then drop it in their lap and they can make a decision. And then sometimes what happens when I do that, the taxpayer say, Jerry, you're right. I did have additional income I didn't tell you about. I said, well, that's really important. Let's get it on the return. And you got to remember, you don't want complications from the federal government and the state government, because those complications are going to complicate your life. And you don't want that. And you certainly don't want a lien, and you certainly don't want a levy. A lien is when the government says, hey, here's your notice, you owe money. A levy is what is called taking. And taking could be from a bank account. It could be from your paycheck if you're a wage earner, or in some extreme cases, the government comes out and they take cars and boats out of your driveway. So you don't want that. You just want to pay what you owe and move on. Okay, I'm going to hesitate for a moment and see if anybody has any comments or questions.
Hi, Jerry. There, Bill DeLuca had a question in the chat, and his question was, if you have a taxpayer who has investment income reported on an information return, are their brokerage fees a deductible item?
Are brokerage fees a deductible item? I think if I remember correctly in the computation, it would go into basis. If you're talking about the Schedule A, I don't believe you can deduct brokerage fees. So that's the best answer I can give you right now.
Okay.
All right, then with that, let's jump to our next one. Again, bank account information. This is not a bridge too far, but you do bump into people. Like maybe you'll bump into a Jerry Muir and you'll ask him, what's your account number? And Jerry will say, I don't know. I have to call my wife or call my bank. I just don't know. Or if you have a check or a deposit slip, you'll have that information. But again, this is not a bridge too far. The taxpayer can typically get this information usually within the day. And some people have it memorized. And you want to make sure you have that correct from some type of bank document, because unfortunately, I saw this a couple times. I think I've seen it like 3 or 4 times in VITA program, where monies were deposited to a bank account and the taxpayer gave us the wrong bank account information. And then I've had people come back to me and they say, hey, Jerry, you put the money in the wrong account. I said, no, I didn't. I said, the IRS put it in the wrong account. And what happened is you provided an incorrect bank account number. And they asked me, Jerry, what can I do? I said, you're going to have to fight it out with the IRS and or the bank. I'm not going to do it. It's on you. Now, of course, I use flowery language. Care and comfort. But I had one client last year, non-paying client. He made the mistake, and I said, I'm just not going to do it. I don't have the time or energy. You can't afford me to chase this down. So chase it down yourself. But the learning point is make sure it's the correct account number. And then, the taxpayer looks at it, nods and say, yes, that's the correct number. If you remember in the software, you've got to enter that bank account number twice. And if I remember correctly, you enter the routing number twice. So it's important to get that right. And again, for a lot of taxpayers, it's not a bridge too far, but again, just reminding taxpayers, based on your information, it's going into your account. We've already talked about global carry forward. I recommend it. I think it's a great thing. In the software, you know that if you're preparing the return, you're going to mark it ready for review. And that's some of the training you're probably going to have before the site opens up. Quality review. This is something I'll just share it with the leadership at St. Killian's. I recommend you probably get your more experienced people being quality reviewers. I think that's important. And then you bring in others, and then they can be a quality reviewer once they've got some experience under their belt. And quality review simply means that you're trying to find everything on the return that's correct. And if there's a mistake or a boo-boo, sometimes you're going to go back to that preparer. I prepared a number of returns that were goofed up, and I've reviewed a number of returns that were goofed up. And so the whole idea is we're trying to help each other. I don't want to play what is called stump the chump. I'm not going to call a preparer and say, hey, you didn't prepare it right, you're a bad person, and wag my finger at them. I may have a conversation with them. They're going to make mistakes. I'm going to make mistakes. And so the whole idea is we help each other. We prepare a return as best we can, and then we file it. And that's what we do. So again, people are going to make mistakes. I've had, in fact, one time I had a tax attorney I was working with. He made a mistake on a return. And we're talking about a guy who had 4 years of, or 3 years of law school and a bunch of tax classes. And he prepared returns for a living, and he made a mistake. It happens. The courtesy copy, I know that we give courtesy copies, hard copies to taxpayers, which is great. So they have a document they can take back to their house, because a lot of times people, they're going to refer to their previous returns for various reasons. So that's good to have. And then reviewing the tax return with the taxpayer, I do that. I'm not going to go through every single line because that is very time consuming, but you're going to hit maybe perhaps your AGI, your taxable income, your tax, and your refund at a minimum. And then, of course, we all know the Form 8879, that's that e-file authorization. Your electronic return originator cannot file the return unless they have a signature on the 8879. And that's typically not a big deal. The taxpayers are instructed to sign it, bring it back to the site, and the return can be electronically filed. All right, any questions here before we move on?
Yeah, there's a comment in the chat, Jerry, that sometimes the bank account information for routing numbers and account numbers on a deposit slip might not be the same as on a check. So we typically look for a voided check.
That's a good point. Yeah, that's a good point.
I also want to point out that at the St. Killian site last year, we had about 20 clients, usually the younger folks, who they have no paper checks at all. They've never had them. They bank entirely through their phones. So then it just gives us a little bit more steps to do in order to verify the account numbers and the routing numbers.
Yeah, that's a good point, because you have all sorts of differences. You have age differences, and you're right. I meet young adults and they have never seen a hard copy check in their life. And, you know, I'm an older guy, and so I was used to checks. I'm still used to checks, but yeah, you're going to see that. So you just work with them and you tell them we're trying to get the correct number, because we don't want this to go into another account, because the VITA people cannot marshal their army and make it so. It's once it goes into that account, that's between the bank and the IRS. It's, you know, the VITA folks are not going to, they should not get involved, because that is not their bailiwick. Okay, just a couple things. We talked about this, I think a couple weeks ago. There's a question about step up in basis. Here's an example of a step up in basis where you have a son inheriting stock after his father passes away. And the father bought the stock for $16,000 a number of years ago. And then the fair market value of the stock at the father's death was $96,000. And so you have what is called a step up in basis, which means in this case, the son's basis is $96,000, which means if he sells the stock for $100,000, he's got a capital gain of $4,000. You may see this. I think I've seen this a couple times in VITA. You may see this. And sometimes it becomes a little bit more complex, which means you probably have to have the individual go to a paid practitioner. And then this is something that you're going to see in 2021 for VITA clients. You're going to see VITA clients who either did not receive that third economic payment, or if they did receive that economic payment, they received either the full amount or a partial amount. And so the full amount for a married couple is $2,800. For a single person, it's $1,400. And then if a taxpayer has kids, qualifying children, then it's $1,400 for each one of those qualifying children. So this is something you want to ask about. And when I was doing this last year, I did have a fair number of people, whether it's 20 or 30%, that said, Jerry, I don't remember if I got one, and I don't remember what it was. They went back in their bank records, and sometimes they could do it in a couple minutes, and sometimes it took them a day, but they would go to the bank and say, okay, yeah, I did receive this payment, and this is the dollar amount. And that's okay, because like I say, if you ask me, of course, I didn't get one of these, but if you ask me, Jerry, what was your last deposit in your bank account? My response is, I don't know. My wife looks at my bank account, or our bank account. I don't know. I got to go look at it, and that's okay. That's okay. Okay, a couple other things, some questions that we had. The charitable contributions, we know the vast majority of our VITA clients are going to take the standard deduction. And that means if they're making cash contributions, and of course, the cash contribution would be a check, could be currency, Federal Reserve notes, it could be a Zelle payment, but that's the definition of cash for our purposes. But if they're making a contribution to a qualified charitable organization, then what happens is they can take that deduction, and in tax year 2021 for a married couple, it's going to be up to $600. So that's a good thing. But again, qualified charitable organization, probably not a big issue. I've only seen it once or twice in VITA where people were making cash contributions to non-qualified organizations. And typically a qualified organization is going to share their tax exempt ID number with the donor, and that way you're good to go. So for example, St. Killian's Church is a qualified charitable organization. So if you're donating money to the church, then you're going to be able to take this this particular contribution deduction. Of course, you want to track the monies that you're donating. Another topic that came up is life insurance, and I'm not a big life insurance guy. I used to have life insurance. I'm now what is called self-insured. So two things you typically bump into. You'll have a person who has term life insurance. It simply means that they have a policy, let's say, for example, $500,000, and they bought it when they were 30, and they're paying some type of premium, let's say $50 a month. So what happens is that individual pays $50 a month, and that eventually they either cancel the policy or they die. If they die, then their beneficiaries are going to receive a check from the insurance company, and that check is a non-taxable check. And of course, life insurance, term life insurance has no cash value, which means there's no savings component, there's no savings vehicle built into term insurance. And if you talk to an insurance person, it depends on the insurance person, they may try to encourage you to buy a whole life. I understand those are bigger commissions, and yeah, people have to live. If you're talking to financial advisors, typically they'll gear you to a term life insurance because it's cheap or cheaper, and you don't have that savings vehicle. Because when you talk about savings, there's a lot of ways you can save money. You can save money by putting money in your mattress. You can save money by putting it in a bank account. You can invest in various things. But whole life is an example, and whole life is a term that's used. There's other names for whole life, and I'm going to stick with that name. What that means is you're buying an insurance policy which has a savings vehicle attached to it. And that savings vehicle, you may earn 2%, you may earn 6%, it depends on the policy. And what that means is you're building up what is called a cash value. And so there's a value in the policy, and so when you decide to surrender the policy, which means you're done, you're finished with the insurance company, when you surrender the policy, you will be issued, if there's any taxable event, which could be, you're going to be issued a 1099-R. And so I think the key here is when someone says, I got a whole life policy, great. What more can you share with me? Well, I got this 1099 because I cashed it in. I don't want it anymore, don't need it anymore. Okay, then let's look at the 1099-R, which means you got basis in your policy, which means you made your contributions, and then the policy earned some type of interest or dividends. And then that would be that amount, that taxable amount that you can see on the 1099-R. I don't profess to be an insurance expert by any stretch of the imagination, but I do know this. If someone says, Jerry, I got a 1099-R for my insurance company, I'm going to ask those follow-up questions, and I'm going to enter that data into the software. All right. Sean, any questions from the participants?
No questions. I just wanted to point out, you were talking about charitable contributions and qualified organizations. A little horror story from last year. We had one client, I was doing a quality review, and she had donated to like 25 different charitable organizations, and she thought they were all qualifying. Of course, we look for the tax ID for all of them, and some of them were actually kind of deceptive, because if you landed on the charities page, it would say they were a 501(c), but they were really a pending 501(c), and it hadn't been approved yet. And in some cases they weren't approved, which makes them not really tax deductible. So the person wound up only getting about half of the deduction she thought she was going to get. That's a pretty rare example, but some of them, we were just looking at them and I just knew they weren't charitable organizations. So, but you got to watch out for that.
Yeah, you do. And I told a horror story a number of years ago. I was working with a VITA client. She's a very generous woman. I actually have talked to her numerous times, and she donated $8,000 to an organization. And we did the deep dive, and I told her, I said, this is not a qualified organization. I said, you're a great person giving money away to help people out, but you can't take a tax deduction. And then she says, okay, I understand that. And from now on, I will donate to qualified charitable organizations. So yeah, that's it. You're going to bump into that. Okay. One other question I had, there's different types of credits for different types of motor vehicles. There's a thing called the Qualified Plug-in Electric Drive Motor Vehicle Credit. And if you're interested in that, number one, it's out of scope. We don't do that in VITA. And if you want to look at the form itself, I actually had a paying client who had this credit. The form 8936 discusses that, and there's a lot of stuff on the IRS website. And so you might see that. So just tell people it's out of scope. What that means is if it's out of scope, they might say, okay, I need to go somewhere else. And if I'm at a VITA site and someone comes in with this, let's say, you know something, you probably want to go to a paid practitioner, find someone out in town to help you out, because this is a significant credit that someone can get. And if they don't take it on their return and we prepare a return, then they're not getting the credit, which means they're paying more tax than they should. So anyway, that's the credit for motor vehicles, plug-in credit. All right. I think at this point, Sean, it's 10:52. And before we take a break, I just remind anybody who wants to stay on, I hope you stay on, and we're going to talk about the John and Lisa Morgan return. Keep in mind, John Morgan meets the tax definition of blind. So we're going to, when we show you the software, he is going to be, we're going to put him down as a blind individual. All right. So let's take 10, Sean.
All right. Take 10, and I'm going to load the practice problem into the chat for anybody who forgot.
Perfect. And then Sean, would you also put down in the scenario that John meets the tax definition of blindness?
The computer I'm using to do this doesn't have Microsoft Word, so I won't be able to edit it. I'll just remind everybody to do their own pen and ink.
All right. I'll tell them make the pen and ink change. Okay. Thanks.
Jerry, did you want me to sign into the practice lab?
Yes, Sean, if you can do that.
And do you want me to share my screen now or?
Yes, please.
All right. Are you able to see my screen?
Yes, I can see the practice lab.
All right. I'll just
And then
maximize that.
Sean, you're also going to bring up the John and Lisa Morgan scenario.
I can, but I'm not, the software doesn't allow me to show two screens at one time.
Oh, okay. So what I can do is I've got it loaded. I can, if you give me permissions, I'll go ahead and show the Word document for John and Lisa Morgan.
Okay, but then you won't see the practice lab. So,
Oh, no, what we'll do is once we describe, show that Word document, then we'll close it out and go back to the practice lab.
okay. So I'll stop sharing. You can go ahead and share.
Okay. And you can see that, Sean?
Absolutely.
Okay, perfect. Sean, you got a good turnout. You got 40 people on the call. That's pretty good.
We had 50 last week, but
Well, it's getting close to the holidays.
yeah, I got about 10 emails this week saying they weren't going to be able to watch, but they'd see it on YouTube. So,
All right.
Ayaw papuntahin ng ate ko siya. Yung dalawang bata sa akin. No. Tama ka.
okay, it's 11:05.
All right, welcome back. We're going to spend the next about 50, 55 minutes talking about the John and Lisa Morgan tax return. So we're going to run through the Word document and then we're going to jump into the software. So we've got a taxpayer. They're going to be filing jointly for tax year 2021. And then some of the topics that we're going to describe in the scenario will be the additional standard deduction because John, the taxpayer, is blind according to the tax definition. We got some Social Security income. We'll talk about the capital gains distribution. I see that a lot in the VITA program, and we'll talk about and define what that is. We have a sale of a stock, and we've got some alimony that the taxpayer has to report. So here's our data. We've got John, the taxpayer. He was born in 1947, so that makes him over 70 years old. He's retired. And then here, I did make this pen and ink change, and if you could do so in your example, he's completely blind in his left eye, and he has 400/800 vision in his right eye. So that meets the definition of blindness. I think I mentioned before, I had a VITA client last season. We zoomed in, I interviewed her, and she finally said, Jerry, you probably don't realize it, that I'm completely blind. I said, no, I didn't know that. And of course, that was one of the questions I was about ready to ask. I said, okay, well, then what happens is there's an additional standard deduction because you meet the definition, the tax definition of blindness. Okay, the taxpayers do not qualify for the renter's credit. And the renter's credit, we talk about this next week, and that's the credit that individuals, if they qualify, what that means is they're paying some type of rent on a property in California. Okay, so we got information for Lisa, the taxpayer, and she too is retired, and she is over 70, so she's also on Social Security. And in your intake and interview sheet, there's a discussion about the stimulus payment, and this is the federal stimulus payment. So they did receive the $2,800, which is the maximum for a married filing joint return. And if individuals talk about the first and or second federal stimulus payment, that has nothing to do with tax year 2021. Here's their SSA 1099. And most of the time, that's a document taxpayers will bring. I've had a couple scenarios where taxpayers didn't get one and they went down to Social Security and they obtained some type of Social Security printout. It had their Social Security number on the document, and that also would suffice for a SSA 1099. So they've got their amounts in box 5 and then their Medicare premiums. And Medicare premiums, if you pay them, and most individuals on Social Security, I don't think there's a statutory requirement to go on Medicare. If you want to go on it, you can, and you have to pay premiums. What happens is those premiums that you pay, they will, once you enter that data into the software, it will carry forward to the Schedule A as an alpha. And then we've got our taxpayer spouse, that's Lisa. She works at a W-2 job. And she's got some wages and she's got various withholding. So we'll talk about that. And then I think we mentioned this before, your state disability insurance, most wage earners in California are going to pay that. Not all of them. Again, I'll use me as an example. I teach at a couple colleges part-time, and I don't pay into the state disability insurance program. When I was a federal employee, I did not pay into the state disability insurance program. So you're going to see that from time to time. People don't pay into it because they have a different program. Got a joint account with interest income, and interest rates being what they are, you're probably going to have just a modest amount of interest from your taxpayers, i.e. they've received interest. And typically that'll be on a 1099 INT. It might be part of their bank statement. But again, if they have $1 of interest income, they're going to report that. Capital gains distribution, the best way I can describe it, you're in some type of mutual fund or a regulated investment company, and you have shares in that company. And of course, subsequently, that company buys shares in other corporations. And so when they sell those shares in those other corporations, they have a capital gain, or in some cases, a capital loss. And then that flows through down to you as a shareholder. So they've got $550. That will appear on the Schedule D as in Delta, along with capital gains and losses. Dividend income, a lot of people have this. Typically, they'll be issued a 1099 DIV, and you will key it as you see it. Sale of stock, thankfully, I think most of our VITA clients, they have maybe a few stock transactions, and their 1099-B as in Bravo is going to be usually a couple pages. Sometimes you're going to find one that's very, very voluminous. And at that point, you may aggregate. That's what I do. I aggregate short and long-term gains and losses, because I'm not going to type for 3 or 4 hours on a VITA return. Other information, they've paid their property tax. They've donated to the American Red Cross, which is a qualified charitable organization. And they did receive a state refund in 2021, but they did not itemize in 2020. And then other things, the association, a lot of people have an association bill. Like I live in a neighborhood, I have to pay a master association. And we're going to talk about that in just a minute. The deductible portion of their bill, DMV bill, is $200. And then Sean, can you do me a favor and read that sentence that says on November 1st?
Sure. On November 1st, the Morgans were notified by the Mission Viejo Gallery shops and malls that they had won an all expenses paid trip to Torrington, Wyoming, worth $3,900. Lisa told the contest organizer the Morgans had been to Torrington twice before, wanted to travel to another location, and turned down the prize.
Okay, so we'll talk about the treatment of that as we go through the preparation. And then we do have a situation where taxpayer Lisa has $4,000 in alimony that she received from a very old divorce. And then the last item, they did file separately in tax year 2019, and we'll talk about that, how that affects, if it does affect the 2021 return. And then based on this scenario, that's a check figure. We should be able to get to that when we make our entries. So with that, Sean, if you can go ahead and bring up the tax layer program.
All right. Should be able to see that now.
Okay. And so what Sean is going to do, and you can see right here, it says 2021. And if you want to toggle back and forth, you go to the upper right-hand corner and you would change the tax year. So we'll stick with 2021. And then Sean's going to make the entries here.
4750. And we're just going to do it with no profile. And then for the people who are new to the system, those profiles can become convenient as you get used to using them. But if you're not used to the profiles, if you go with no profile, you'll just have to answer every single question.
Okay, and so the software that we're utilizing is a work in progress, and that's what this message is. So we're going to hit continue. And then they are electing to file married filing joint, which is an election. They choose to do it.
All right.
Yeah.
I got to get a little bigger
And
here.
then Sean is going to populate the personal information for John, the taxpayer, and Lisa, the taxpayer. And then as he populates that, just a quick aside, again, we've got our John, the taxpayer. He meets that definition of blindness, which means he gets that additional standard deduction.
Whoops.
And yeah, John was born in 1947. There you go.
Taxpayer.
Okay, Sean's going to indicate the taxpayer is blind, which means that additional standard deduction is going to be added.
All right.
And then our taxpayer spouse is Lisa, the taxpayer.
Lisa is March 1st.
March 1st, 1950.
Well, same birthday. So.
And for your taxpayers, Yeah, typically you're going to look at their driver's license for date of birth. And as I mentioned before, Social Security, I know a guy who was on Social Security when he's 56, but the general rule is typically you're looking at 65. For guys like me, I got to wait till I'm almost 67. Okay, and then they've got an address in Mission Viejo. And then also, if you have someone who's been awarded Social Security and they've been paid in arrears, the publication 4012 talks about that lump sum payment. And so you get that once in a while in the VITA program. So you should go to your publication 4012, and there's a way to treat that lump sum payment for Social Security. There are no kids, so we'll hit no. And then the recovery rebate in the scenario, it says the Morgans received their third round. So Sean is going to indicate yes, and they received $2,800.
And then just a quick comment on the dependents. It's unusual, but every now and then we'll have a person who's retired and has an older parent who's their dependent. It doesn't have to be kids.
Yeah, you're going to see a lot of different things. Now, this is something I did not see last night. It says search for them with quick file. So I'll plead ignorance there. Do I want to use quick file? I don't even know what it is. So I'll say no and move on.
We'll say no. I'm sure that means it's like global carried forward. They're already in there. They have electronically scanned W-2s. We saw some of that last year.
Okay, so W-2 for Lisa the taxpayer. We're going to enter that data. And then as Sean makes these entries, just a couple things you should keep in mind. If the taxpayer has a corrected W-2, they'll get that from their employer. If they do not have W-2s and they have their their year-end pay stubs, then substitute W-2 can be completed. But typically, you're going to have a W-2. And then your employer name is the T-shirt shop. And yeah, that red, that happens to me too. So that means you don't make a complete entry. You just go back and you, I think the term was get the red out, get the red out.
Yep. All right.
She has wages of 17,000, and you're going to see boxes 3, 4, 5, and 6 auto-populate. So we're not going to make any changes there. She's got withholding of $500. We talked a little bit about allocated tips. Sometimes you're going to see that. So if you have allocated tips in box 8, it will not be reflected in box 1. So again, go back and look at that IRS publication we talked about. If you have a tip situation, you have to address. All right, let's go down to, Sean, can you open up 12 and just show them D? There you go. So typically in the VITA program, D, deferred compensation, or DD, delta delta, would be for health insurance paid by the employer on behalf of the employee. But in this case, we don't have that, Sean, so you can make that code in box 12 go away. And then 13, sometimes you have retirement plans. Again, you key it as you see it for VITA. Box 14, that's going to be for your state disability. We talked about this before. If someone's getting state disability checks, that's going to be a non-taxable event because they pay the premiums. And then we're going to go down to the state information. And as I've mentioned before, your state information is typically going to be the same as your federal, i.e. your state wages will typically be your federal wages, typically. And we mentioned before, box 18, 19, and 20, you ignore that for California VITA because there are no jurisdictions in the state of California that have an individual income tax other than the state of California. Okay, so there's our W-2. And we're going to go to our Social Security, which is the SSA. And then we open up the Social Security tab, which is the third one. And then in this case, we've got Social Security received by the taxpayer, $16,000. And then they paid Medicare premiums of $1,400 taken out of their Social Security check. And then the wife, she received $18,000 in Social Security and she paid $1,400. And then Sean, don't click on this because $1,400.
Yeah.
There you go. don't click on this, but just take your cursor and just kind of circle around the, there you go. So if you have a lump sum payment, what that means is an individual said, hey, Social Security, I'm eligible. I didn't get my payments over a couple of years. You might see that it'll be reflected on the SSA 1099. All you need to do is open up your 4012. Don't click on it, Sean. Click on the worksheet and then make your entries. You will see that from time to time. I think I see that a couple, 2 or 3 times per season. All right, let's hit continue. And then we're going to go and hit continue again. And then we're going to go to our interest income. And in this case, they received $60 from Chase Bank. And then, of course, typically you will have a 1099 INT with all of the information from the bank. And you can make up an EIN there, Sean.
You've got one in there. 1, 2, 3, 4, 5, 6, 7.
And total interest income was $60.
Joint account.
It is a joint account, correct?
Yep.
And then, Sean, don't enter anything here, but the early withdrawal penalty, again, sometimes you're gonna have a situation where the person cashes in their certificate of deposit and the penalty is going to be interest. And so sometimes you do see that early withdrawal penalty. So you simply key it as you see it from the 1099 INT. All right, I think we're done with that. That's typically the entries you're gonna make. And now Sean is going to go to the upper left-hand corner and hit where it says add interest and dividends. And he'll open up that DIV. And we've got big corporation.
Oh, not Buffett.
Oh, we'll put in buffet later.
Okay. All right. EIN is 6. And all right.
And that's just for the taxpayer. Ordinary dividends are $20 and qualified dividends are $10. And so again, you want to key it as you see it. Okay, so that's it for big corporation. And then we're going to go ahead and open up another 1099 DIV. And this will be for the Buffet Mutual Fund.
Whoop. I don't know zip code for New York.
Zip code, oh, I didn't put one in. How about 100? And the question is it necessary to put in the bank EIN? I don't think you can get past the screen without entering the EIN. So I would say yes.
It's in there. It's a red. It's got a red asterisk. Anything with a red asterisk, you won't get past the screen if you don't put it in.
Yeah, yeah. Okay, so let's stop for just a second. So what we have now, we have John, the taxpayer, has received a 1099 DIV, and the box 2 alpha amount is $550. So you're going to cursor down just a little bit, and you're going to go to that capital gain. And for our new and newer taxpayers, what that really should say, it should say capital gains distribution. A capital gains distribution is a different animal than a capital gain. So this is capital gain distribution. We're going to key it at $550. And what that means is John, the taxpayer, he received a capital gains distribution from his mutual fund company because they sold capital assets in other corporations, and then that gain flowed through down to John, the taxpayer. Okay, so we're good to go, and it will appear in the Schedule D as in Delta. All right, let's go ahead and go to our next information, and we've got sale of stock. And so a couple ways you can do it. You can hit cancel here to get out of this particular one unused. And we're going to hit continue, or we're going to go over to income. And we're going to open up our capital gains. So if you go over to income, click on that, you'll get your drop-down menu. And then you'll see that capital gains and losses further down there. All right, he'll hit capital gains. We've got one transaction. And this would be for a joint account. And the taxpayers sold 100 shares of MMMI. And you're limited to the amount of, oh, there you go. Good job. Okay, date acquired. They bought it on September 3rd, 2013. And the date they sold it was November 1st of 2021. And they sold it for $6,000. And in the drop-down menu here, this is typically what you're going to see. This is what I see. Cost basis reported to the IRS. And if it's not, all you got to do is ask some questions. I've had many a taxpayer saying, I don't know what I paid for it. And then what I do is I try to help them out as best I can. Sometimes they'll do the research and find out what their cost was.
Jerry,
Okay,
do you want me to show the drop down for what happens if you say not reported?
No, we're going to
Okay.
go down a rabbit hole.
All right.
Okay, cost, let's go ahead and indicate $1,400. And so what we see right here, we know this is long-term based on the dates we entered. We also know there's a gain, and that's all we have to do for this particular transaction. So we're going to hit continue. And then let's go ahead and hit continue and then bounce over to our deduction. And then we've got that Red Cross donation that the taxpayers made. So we'll go to the itemized deductions. And we'll go to gifts to charity. And our cash gift to the Red Cross was on June 3rd of 2021. And that was cash. And we donated $550. And then real quick, if you can, Sean, if you can go ahead and hit continue if you would, and then go to non-cash gifts to charity. So again, you might have a taxpayer who's driving their personal automobile and not being reimbursed, and they're driving for a charity, Meals on Wheels or something like that. So if they have that, number one, they want to account for their miles, and you can account for your miles different ways, but you want to track your miles, and then you can enter it right there, which is charitable miles, the total number of miles you drove for the charity. And then that way, if they itemize, they can get a charitable contribution for that. Okay, you can hit cancel. Done with that.
And you could deduct miles driven back and forth to a VITA site if you're a VITA volunteer, right?
Yeah, if you're a VITA volunteer, back and forth, yeah. I belong to a charity, and we do meals for certain people, and so we'll deliver the meals, and that's part of the charitable contributions. We don't open up any tabs, but if you have people who are donating clothing items, chairs, refrigerators, computers, those are your non-cash donations, and there's a whole IRS publication that talks about that. So, okay, let's hit continue. And then let's go ahead and go to our next income item, and that would be alimony. And in the alimony example, we have Lisa, the taxpayer. She received $4,000 in alimony. And this would be from a divorce back in 1990. So this is, and what you'll do, Sean, go down to amount of alimony spouse received.
Oh, yeah, sorry.
And so again, I think, I can't remember if Paul or someone else brought this up. So when you're talking about alimony, you have to find out when that divorce occurred, and the Pub 4012 does a really good job. But typically those brand new divorces and the alimony being paid out is not going to be reported as a taxable event. But again, you do have to differentiate. Okay, he'll populate that and hit continue.
All right.
Okay, a couple things. If you have a scenario in front of you, let me run through a couple items in the scenario. There's an indication that the taxpayers filed married filing separate in 2019. That has no bearing on the 2020 return, so you can ignore that. There's also discussion about the taxpayers turned down or rejected a prize to go to Torrington, Wyoming, all expense paid. When you turn down a prize, and I did that before one time, somebody called me up and says, hey, Jerry, you want a frying pan or something like that? I said, hey, you know something, thanks. Not interested, give it away to someone else. I'm not going to claim it. So that means you do not have actual or constructive receipt of that prize, which means you don't report it on your tax return. This is not going to make a difference on the return, but we're going to run through this because this is important. Sean, can you go back to the Schedule A as an alpha? And on taxes, once he opens that up, and he'll go to the itemized deductions on the left-hand side.
Oh, sorry. Got to go to deductions.
And he'll open up itemized deductions, and the taxpayers paid the deductible portion of their DMV bill was $200. So we'll go to taxes paid. He'll cursor down, and you'll find that section that says personal property, and that would be $200. And again, that's the deductible portion. He'll close that out, and then back to the scenario, it talks about the master association. That's a non-deductible expense. If you have rental property, which we don't do in VITA unless you're military trained, if you have a rental property and you're the landlady or landlord, then you can take your association bill as a rental expense, but that's not the case here. We've entered, no, we didn't do property tax. So let's go back to the Schedule A as an alpha again. And Sean is going to open up, not that one.
Oh, well, real estate taxes is on that line.
Here we go. You're absolutely right. Okay, real estate tax is non-business property. That's your personal residence, $2,200. All right, and you're going to save that. The tax refund that he received from California in 2021 for tax year 2020, there's no tax consequence there because they did not itemize on their 2020 federal return. And so it looks like I'm going to run through it one more time. And if anybody sees something that we missed, shout out. But I'm going to run through, and I think we've made all of our entries here. All of our entries. Okay. Yeah, we have. I think we're good to go there. We're good to go. Okay, so if you would then, Sean, if you can go ahead and go down to insurance on your left-hand side, open that bad boy up. And we know they're on Medicare, so Medicare is part of that minimum essential coverage. So the answer is no, they're not in covered California. And then Sean, can you open up and hit continue? We're not doing California, not available. If you can open up the form 1040.
All right.
All right. And I don't know if you can open it up in such a way and show a PDF document to everybody.
We will see.
All right, here we go. And so you got two choices, either print your return or alternate method. What do they say? A 50-50 chance.
Well,
Don't you have to click on one or the other?
Yeah,
so
click on print. You don't have to print it. View it first.
so I already did that, but this is one of the things about viewing it through Zoom that's different. It's already showed up on my computer, so I'm going to have to stop sharing that one screen and switch over to the PDF, because that's actually a separate program that opened. But that is also something to be aware of if you are doing people's returns at your house or another remote site that meets all the IRS security requirements. Remember that every time you open somebody's PDF on your computer, you now have their information on your computer. You have to remember to delete that when you're done dealing with that individual.
That's a good point. Yeah, you don't need it once you're done reviewing or preparing. And Sean, I do have this document. I have the PDF document on my computer. So if you give me permissions, I'll just, oh, there we go.
Well, I'll put it open.
All right, perfect. So what we're going to do, we're going to go down to this page right here. Can you
sorry,
cursor
summary
up a little
page?
bit? Yeah, and stop and go down very slowly and stop. And so you're familiar with this. If you've done returns before, you've got this, this is your quick summary, and you can see that the taxpayers, it shows total income, it shows AGI, it shows taxable income, and then it shows the amount of the refund. And so this is something that will be helpful to you when you're preparing returns. If you go to the, and don't move the page, please. If you go to the upper right-hand corner, a little bit lower, it says effective rate. That's the effective tax rate, 0. And as I tell people, that's as good as it gets. There's no tax for these taxpayers because they did have a long-term capital gain. So Sean is going to go slowly down to the next page. Okay, there's your summary of your income, both Social Security and your W-2. And he's going to go down to the next page. Here's your facsimile of the W-2. And he's going to go to the next page. And again, the 8879 is something that you have to have the taxpayer sign. You can either have an electronic signature. Some people get worked up about electronic signature, and I tell them, I think back in 1993 under President Clinton, he signed federal law. So when you sign electronically, that's a signature, and that's acceptable by IRS standards and acceptable in the court of law. Okay, so next page. Okay, here's your 2021 tax return, and you'll notice this is SR, so that's for seniors. And the intent here is make the font a little bit bigger. But again, you're filing either the 1040 or the 1040 SR. Again, the software does it for you. Now we're going to look at this real quick. We see wages from the W-2. We see interest income and ordinary dividends. We have the Social Security payment, and a portion of that is what is called taxable. And we'll show you the sheet in just a moment. We have that capital gain and that capital gains distribution, and that's reported on line 7. We've got the other income, that's alimony on line 8. And then the total amount on line 9 is that 31,000 change, and that's the same as AGI. Let's go to the next page. Next page, you see the standard deduction, and that is going to be for these taxpayers and that additional amount because John, the taxpayer, is blind according to the tax definition. You see the charitable contribution, they gave $550, and that comes right off the top. And so that brings us down to $29,700. And then line 15 is the taxable income, $2,145. And the best way I can describe this, if you go to line 24, it says total tax, the answer is 0. And the reason the answer is 0 is because when you go to the qualified dividends and capital gains tax worksheet, you're going to see that that 2145 is subject to a 0% tax, which means 0 tax. There was a total amount withheld from Lisa, the taxpayer, of $500. And so if Sean cursors down, that's going to be the refund. And then we all know on the bottom of the document, you're going to see the bank information. As we said before, very important to get that right. And so that goes to the right account. And then, of course, the penalty of perjury thing, that's described where it says sign here. And when the taxpayer signs an e-file authorization, that means they have signed their tax return. And so there's the data down there. Okay, and next page. This is simply a discussion of the standard deduction, and you can see where it says married filing joint and the number of boxes checked. And so, of course, box 1 and 2 for husband and wife over 65, box 3 for the blind taxpayer, and that's at standard deduction 29,150. Here are your additional income items: divorce, alimony received, and that's at 4,000. Okay, nothing here. Adjustments to income, itemized deductions. This will appear even though they don't itemize deductions. That's the way the software is. I can tell you this, we give the whole package to the taxpayer. In my practice, my paid practice, I typically remove the Schedule A if the taxpayers take the standard deduction. But for VITA, I give it to them anyway and just explain it's generated by the software. Okay, next page. Here's your write-up for your interest in your dividend. And then in some cases, Sean, go to part 3 if you would. Down here on the Schedule B, if a taxpayer has an account in a foreign country, you want to make sure you identify that. It doesn't mean they're a bad person. It simply means they have an account in a foreign country. That's all. Schedule D is in Delta. You can see the long-term capital gain, and that was at $4,600 in part 2. And then you can see a little bit below there, you can see that capital gains distribution of 550. And then Sean, don't do anything, just hold it steady. If you go to line 14 and you go to line 6, there's where that capital loss carryover appears. So if you have someone who's got a capital loss carryover, the software from the previous year will identify short and or long term, and then you're going to enter that data into the software and you're going to have a calculation. But that doesn't apply here, so we're going to move on. Summary, okay, great, move on. This is your details on the sale of shares. Move on. Move on, we don't need to look at that. And stop. Okay, so this document, sometimes people will look at you and scratch their head and say, well, why is this? I think I shared the story before. We had a taxpayer sitting there. We had a CPA, another CPA sitting there. And these are sharp CPAs. And they go, Jerry, what's going on here? Why is this taxpayer not paying any tax because they've got taxable income? I'm thinking, oh, well, that's probably long-term capital gains taxed at the 0% rate. So Sean, if you take your cursor and go to line 9, line 9 talks about an amount, once you go through the worksheet, taxed at 0%. And that's what the software has done here. So that's the explanation of why, even though they have taxable income, they have no tax that they're paying. Because again, that's taxed at the 0 amount. Again, the long-term capital gains rate. And so again, when you go through the worksheet, I would recommend if someone asks, then simply go through the qualified dividends and capital gains tax worksheet. If they don't ask, you can just say, hey, here's your tax amount. And because you're in a lower bracket, if you will, you don't have any tax. And a lot of times people say, okay, I'm all right with that. And if they're not, I start at the top. And I learned this a long time ago. And again, I'm not being flippant. This is important. When you're looking at a tax document, a tax form, start at the top and you work your way down. If it does not apply, then you move on. And then that way you can explain to anyone, whether it's a practitioner, a CPA, a VITA volunteer, or a VITA client, they'll understand exactly what happens. Start at the top and you read or have the taxpayer read, and then you can plug that amount in, refer to your form 1040 and walk through the form. And when you walk through the form, yes, it sometimes takes a little time, but the explanation is given to the individual who's listening to you, and they say, okay, I got it. And so that's the explanation of why there is no tax on this tax return. So, and if you go to line 25, Yeah, line 25, it leaves it blank. Some other softwares may generate a 0, but in this case, there's no tax for these taxpayers. And that's why they're going to get that refund of that $500 withheld from the paycheck. If you can go down to the next one, this is a sheet, if you will, from the instructions to the 1040. And then we'll go to the next one. And again, a sheet from the form 1040. And then your Social Security benefits worksheet. Again, this explains what I would do if a taxpayer asks. I would probably refer down to line 18. Again, we're not going to spend 5 and 6 hours explaining a return. I do have some clients, my paying clients want me to explain every line. I tell them I will do that for you. It's $200 an hour. And they usually say, okay, Jerry, just give me a 5-minute summary. And I give them a 5-minute summary. But some of my clients want me to walk through each and every line, and I do. But typically, you're not going to do that for a VITA client because they're interested in the bottom line. Okay, next slide.
Yeah, I'll just say, Jerry, we did have some surprises last year where you remember there was a deferral. People were getting unemployment income and the government had said they weren't going to tax the first 10,000 or something of unemployment income.
Yeah, that was, and I'll just,
but
what happened is you had, when we first started doing returns, unemployment compensation for the federal government was fully taxed. And then what happened is the legislation passed in March. And so what we did after that, the software then was updated. So yeah, I mean, and a lot of people, they get frustrated and they go, hey, why is this? And again, you just tell them, hey, things change and we can't control Congress. When a change is made, the software is updated and we do the best we can. So yeah, that happened.
Well,
how about
what I wanted to point out is that even though they didn't tax it as income, it did count towards this calculation to see if your Social Security would become taxable. And so that caught some people by surprise.
Yeah. Okay, let's go down to this one, the recovery rebate credit. Again, we're working for tax year 2021. And so what we're interested in is that third economic stimulus payment from the federal government. And in this particular case, they got the $2,800. So if Sean goes down to that bottom line, we're going to see on line 14, there is no recovery rebate credit. And again, when you're working with taxpayers, they may confuse the state and the federal one. Tell them the federal one is your concern. The state one doesn't go on the federal return and the state one doesn't go on the state return. And then that should suffice for your taxpayer. All right, Sean, thank you. That takes care of it. Any questions regarding the preparation here?
Let's see. Well, there is one question in the chat about, you were saying sometimes we have to have a conversation with a taxpayer, and Bill DeLuca is asking, doesn't the quality reviewer have to do that explanation?
Yeah, and that was a general comment. So when I say having a conversation, that could be either the preparer and or the reviewer and or the site coordinator. So the answer is it depends. It depends. But typically what we do, the individual who's interviewing is typically not going to be the preparer, at least at St. Killian that I've seen. So you got the interviewer, you got the preparer sometimes has follow-up questions. The reviewer sometimes explains and has follow-up questions. So again, it just depends. It just depends. But I think that the takeaway is having the conversation and asking those questions that pertain to the return, and then making sure you perfect that intake and interview and understand what you have. Because again, like I say, taxpayers are like people. They're all different. And I mean, if you prepared a couple hundred returns in your life, you know every return is different, and there's just a lot of interesting and different things. And so, again, I'm the type of guy. I was trained by the IRS. I ask a truckload of questions, and I want to get to the right answer as best I can.
Okay. Well, thanks, Jerry. I think we're nearing the end.
Okay, very good. So ladies and gentlemen, if you join us next week, I hope you do. We're going to do the deep dive into the California return, the Form 540. We're going to talk about covered California, and we're going to talk about conformity and non-conformity that California has with the federal return.
Okay.
All right. Thanks for joining us. And Sean, thanks for driving.
Oh, you're very welcome. Thank you, Jerry. Thanks, everyone. We're going to be ending the session now.
Thank you.
Take care.
Thank you.
Thank you.